Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's taken as personal investment advice. It's always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. This quarter basis point cut, risk management cut, as Powell is referring to it now, and the overall this Fed dot plot is quite confusing. So interested to hear Rob's thoughts on that, and also as we look towards the next PCE report and implications thereafter. So let's go ahead and kick off into the session. Thank you all for joining us live, and yeah, as I said, let's get started. Rob, you out there?
Hey, I'm Zach. Hey, everyone. Welcome to TradeFinder Live. Hope everybody had a great weekend. Start of the week has been kind of continuing on with this melt up to the upside that the market has been moving on. And once my internet decides to cooperate, we will be able to show you the screen. So here we go. Hopefully everybody can see the screen now. Can you confirm the screen's up, Zach?
Yep, we got you.
Okay. Taking a look at the moving averages, we continue to stay above the 10-day moving average. As you mentioned, Zach, the dot plot kind of non-committal, a bit confusing. Basically, if you don't know what that is, that's when the FOMC governors put little dots on a chart on where they see the future of interest rates. It's nothing scientific. It's just opinions. And if there's a consensus, then you kind of get an idea of where the Fed's likely to go. And if we're in a case like where we are now, where it's all over the map, you have no idea what the Fed's going to do. They've said they're going to be data dependent. They're going to take things meeting by meeting. They seem pretty content with their 25 basis point rate cut. And now we wait and see what the data shows, because they've told us they're going to be data dependent. And that next PCE report that you mentioned, Zach, comes out on Friday. So that'll give us a little bit better idea. I think we continue in this melt up as we have been for now. As we move up into this ascending pennant pattern, we stay above the 10-day moving average. We're a little bit above things today. We've sold off just a little bit from the open. That's not a good number of where the S&P was or SPY was. But the odds are, at least at this point, and we'll see what happens when Friday comes, that this last zigzag that I've been talking about, I talked about this over the weekend in the U.S. market update as well. We're in a wave three, and from Elliott Wave, we all know that a lot of Elliotticians say stay away from the wave three, although agreeing that it's the strongest and often longest of all waves. It's very difficult to know where the wave three ends and the wave four begins. But I've always maintained that if you can find a zigzag within the wave three, that gives you some percentages in your favor of where the wave three may likely go. And why do we want to ignore the strongest of all waves? If we can find a way with some sort of accuracy to trade the wave three, that's what we want to do. And so this hub software allows you with this zigzag tool to draw zigzags within the wave three. And by the way, while I'm mentioning software, if anybody happens to be watching that hasn't gone to hub.com and gotten a copy of the software, go do that. It's free. The Elliott Wave counts are free. There's an opportunity to subscribe to the AI signals if you'd like to, but you don't have to. The software itself and the Elliott Wave signals are free. The AI had given us this 652 level back in June, 62% chance we'd get there. We got there. And then we kind of hovered around that level, as well as a little bit of sideways movement for almost 2 months here, a little over a month, and then broke higher again as the Fed rate cut was anticipated. I was a little surprised that the market didn't react differently to the Fed meeting. I thought we might get more of a volatile move one way or the other. I thought if the Fed surprised at 50 basis points, which I thought was a very low chance, because that almost is the Fed admitting they've been wrong by not cutting up till now. So I didn't think that was going to occur, even though there were some whispers that it might. So I thought maybe the 25 basis point rate cut, especially on top of the fact that they backed off. They've been all over the map with their dovish versus hawkish commentary. You know, during the last FOMC meeting, Chairman Powell was almost defiant and hawkish. And then we got the Jackson Hole comments where he flipped the script and he seemed dovish and gave us the indication that they were going to change paths and start likely easing. But then the market took that and priced in 75 basis point rate cuts, a 75 basis point total rate cuts between now and the end of the year. And we don't know that that's going to happen. This month-to-month data-dependent thing, anything could happen from now till the end of the year. I think I said in a month, I meant in a year. And so I thought that could create some disappointment in the market, and we might start to see that wave four correction, especially when we coordinated that zigzag pattern with the 100% extension. The B wave corrected 50% spot on, which gives you a 100% expectation on the C wave. And we went there right in front of the Fed meeting and didn't disappoint. I thought there was a slight chance that if the Fed even only cut 25 basis points, but then gave dovish commentary like we're embarking now on easing, that could be enough to create the FOMO spike, the fear of missing out. There are reports from one of our subscribers at ewotrader.com talking about how there's some institutions that have a lot of cash on the sidelines, just like the retail trader. We know how much money retail traders have in money market accounts. That's been well documented. But then there's this aspect of playing catch up. Investment managers make the majority of their salaries from bonuses at the end of the year. In other words, they need to outperform the S&P. They've been keeping some powder dry, so they've got a lot of cash. Also expecting, I think, at some point, a bit of a correction. And then once we got the correction, they'd step in and put that money to work. Well, they haven't had that opportunity. Every single one of these little moves down has been bought into. We're programmed into buy the dips right now. At some point, that won't work, but it works until it doesn't, type of thing. And so we didn't get either one. We didn't get a correction. We didn't get the FOMO spike. So we just continue this melt up. So the likely next target is going to be this 161.8% extension. Oftentimes, especially in a wave three, the C wave will extend past the expected target to the next target. That's why it's known as an extended C wave. So we look towards that level. I don't know if we can get there by Friday. The reason that I keep talking about that PCE meeting is if we start to see inflation kick up, and Chairman Powell did make a comment on the financial networks this morning that was released on the financial networks, that the risk to the downside of the jobs market is being offset by risks of a tick up inflation. So that's why they're kind of, what do we do? Inflation's a little bit higher than where we want it to be, and they're concerned that it could tick higher. But they also are acknowledging that the jobs market is weakening. So it puts them kind of between a rock and a hard place as far as what to do. And you might think it's easy, just cut rates. And if inflation comes back, stop, or you can always raise rates again down the road. Yes, but two things here. One, the Fed is overly concerned about not repeating in fact, this was just mentioned on the financial networks yesterday. I hadn't heard it in a while. The mistakes of the 70s, where the Fed cut rates too soon into an inflationary environment, and inflation came roaring back, and we had wild inflation back in the 70s. There was even one person talking today that I can relate to. Sorry about the tangent here, but I think it's interesting. Maybe you don't find it as interesting, but where to get gas, there were odd days and even days. And depending on, I think it was your birthday, you could only get gas on either an odd day or an even day. And I can remember having my car parked in line, literally parked in line to get gas because you didn't want to burn gas while you were sitting waiting at the gas pumps, and you would just push your car, a car at a time until you got to the pump. So they don't want to repeat any of all that stuff that occurred back in the 70s. So they're overly conscious of that, which I think is part of the reason that they have not been quite as apt to cut rates into the jobs market, where that can be a concern. This is the last point I'll make, and then we'll move on to more charts, is the fact that a rate cut or a rate hike is not an immediate fix. The only thing that does is change the banking's overnight lending percentage. That's it. Everything else takes a while to work its way through the economy to help the jobs market or the economic numbers, et cetera. So the only thing immediately affected again is the bank's overnight lending rate. So if they wait too long on the jobs market, it will start to affect the economy. But what do they do if the jobs market continues to weaken and that weakens the economy, but inflation stays stubbornly high? Then we get the worst of all worlds. We can handle inflation, we can handle deflation, but stagflation is a problem. So all those things remain on the table. But for now, we trade with what we have in front of us. That's what technical traders do. We think about those things, we keep them in the back of our mind, but we can't trade off that stuff. We have to trade on what the charts are giving us at the moment. Listen to the market and go with what the market is telling you. It doesn't always make sense, but that's the way you become successful. And for now, we're still in this trend. We're still above the 10-day moving average, and we're still in a wave three, and we seem to be heading towards that 161.8% level. Okay, enough on that. The next point that I've been talking about, odd formations in the charts here. And then some people have said, is it really that odd? And it's a fair point that I'll talk about in a second. The Dow having a nicer day today, and there was a comment today that I thought was interesting on the market rotation. It's like rotation roulette that's going on right now. That's pretty accurate. You see the tech sector going up one day, the next day beaten down, oversold stocks are moving up. So it's a very short-term minded market that we have at this point, which tells you that there's a lot of retail traders in the market. And I think that's making the institutions quite nervous, because as the S&P continues to go higher, those investment managers that have not outperformed the S&P are at risk of not getting their bonuses at the end of the year. And it's important to note that that's where their main source of income comes from. Obviously, they're paid well, but their big money comes from beating the S&P and getting their end-of-year bonuses, and they have to outperform the S&P to get those. So that performance chasing comes from when investment managers that have underperformed come piling in. They try to pick the spots where they can get the greatest return, tends to push the markets higher if we get to that point. And that was very eloquently asked by one of our subscribers, as I mentioned, Maria, if she's listening. Kudos to that. So that's a possibility of driving the markets higher. But I think what you're seeing in this Dow chart here is that rotation. So the S&P underperforming the Dow today. And the fact that the Dow's in the wave 5, at least as evidenced by the DIA, is interesting, because then when we move to the Qs, you can see that we're still in a wave 3. So the SPY and the Qs are in a wave 3. Those two movements look very similar. And then we go to the IWM, and I think this will be where the rubber meets the road. It is the risk on, risk off. And look at that. It's in a wave 5, just like the DIA, and also having a better day today. So there is some rotation. I did hear a money manager yesterday that said that they were afraid of the small caps, because a good percentage of the small caps don't make money. And small cap stocks are the most rate sensitive, because those are smaller companies. They still need to borrow money to grow and expand. They don't have big war chests like Apple, et cetera. So they need lower rates so that they can borrow money and grow their business to get out of a small cap classification. So isn't it interesting that the two markets, the DIA and the IWM that are in wave 5s, are having better days than the two markets, the SPY and the Qs, that are in the wave 3 are today. So clear indication of market rotation, which means what for us as traders? It's a stock picker's market, if you've heard that term before. So we've had this long era where the big tech stocks have been driving the market. 7 to 10 stocks have been responsible for the majority of the gains of the SPY. But perhaps that is going to wane a bit, and you're going to have to get a little bit more specific on picking your stocks if you want to generate better gains. And I think that's being evidenced by the DIA and the IWM today. They're both showing that kind of a scenario going on. Well, now look, now we're getting a little bit above the 10-day moving average. So do we rotate back to the SPY and the Qs tomorrow? Wouldn't surprise me. We'll wait and see. But that's what's going on at this point, which to me makes the AI and individual stock picks really, really important. And I think you're going to like the one that we have. I'm just going to go ahead and preface this. Zack will be on later to show you the social media aspect. I want to leave enough time in today's webinar so you can show that. But I think you're going to like the case study consideration for today, at least based on the comments from the U.S. market update that I've been getting. So pretty exciting to show you that. All right, now let's move to the bond market, which is giving you a bit of a reason why the IWM is up today. The chart of TLT. Sorry, maybe I have too many windows open on my platform today to go ahead and close some of these off and see if I can get a little quicker movement here. Rest assured, it's the internet. It's not the. I've got a lot of stuff going on, so I'll take out some of the bandwidth. Starlink is great, especially when you're in a place like I am in the mountains. But when you have a really cloudy day like today, it can be a little bit intermittent. So just know that it's not the end all be all because weather still affects it like it did in the early days of DirecTV and all those other things. All right, so here's what I wanted to show you on TLT. A little bit of a tick up in prices. Remember, TLT is prices on the 20-year, prices and rates move inversely. So a little tick up in prices, a little tick down in rates. You get a bit under the IWM. Now, that's rate sensitive. They're correlated pretty well right now. And I wanted to mention that correlations work until they don't. So if you start to identify a correlation and say, this is it, this is the golden ticket, this is what I need, I'll just follow this and this will work forever. Nothing works forever. But you can find short to intermediate term correlations that do work. And right now, that's working well. You can see we had this big breakout move here. I felt like the bond market was a little anticipatory, if that's even a word, of maybe a slightly more dovish Fed based on Powell's comments at Jackson Hole. They didn't get it. So back down we came. But they were guarding against it, which was interesting to me when going back. The bond market has been really non-committal on where the Fed was going to go. So I've opined on, was the bond market confused on where the Fed was going to go? Or was the bond market actually foreseeing the fact that the Fed doesn't know what they're going to do? You see what I mean by the difference? The dot plot is confusing. It's a mess, as Zack said. We don't know. We had no direction from that whatsoever. And perhaps the bond market was anticipatory of, hey, the Fed doesn't know what they're going to do. And so we're just going to stay status quo. And we had all of these consolidating triangles. The only directional moves were the breakouts of the triangles and then right back into another consolidation. So perhaps the bond market was a little smarter than we thought and forecasting the fact that the Fed doesn't know what it's going to do, other than it did guard against a surprise at the Fed meeting, which didn't occur. So they're taking that back at this point. And then let's look at the dollar. And the dollar is something that you need to watch for metals. And the metals really tend to move a lot with the dollar. And gosh, this movement down here worries me on the dollar. As you know, you've been watching week in and week out. You're tired of hearing me say this. I don't want to see the dollar come down here to 90, but the monthly chart does show a couple of times over recent years where we've been down here. I just feel like it's going to add unnecessary unease to the equities market, or maybe necessary unease, but let's just leave it as unease to the equities market because at any point in time that one of those countries that has a boatload of dollars decides they want to sell, that could really create a problem for the equities market in the U.S. economy. And just to further that point, I don't want to leave it on such a negative. The reason we've been able to get away with this, the amount of debt that we have, and the reason that other countries are still buying so many dollars and it's still viewed, at least for now, I don't want to lose that status of the currency of last resort, is because we are the consumption engine of the world. And all those other countries need us to buy all the goods that they make. So if they damage our economy by dumping dollars, they're in facto damaging their own economies because there's no one out there as big as us buying goods and services. So that's helped us from not having a lower dollar than where we are right now. But we do need to keep an eye on that because you can see there's a tick down in the dollar today. And I'm just going to jump right to gold because this is mind-boggling to me on this move higher. And we did have a trade. We put it in the speculative portfolio at evotrader.com because when you have a triangle, you have to respect that it can go either way. I drew these lines on what direction you could go. And even Elliott himself said, when you have a triangle, you ignore the Elliott Wave pattern. You don't pick a direction. You let the triangle break out, or you trade a strangle, as we often do in the volatility portfolio, and set up to capture a move of significance in either direction. Doesn't matter which way. But we did pick a direction. We happened to get it right. We picked to the upside because it did seem the Fed was going to at least start easing at some point, even if it wasn't significant. And it was probably, other than a real disappointment of not cutting rates, it was about as hawkish as it could be, considering we did get a rate cut. So we took the trade off when we got to this level, which was the rule on how far you break out when you have a triangle. You measure the mouth of the triangle and you take that from the point of the triangle. It could go that much higher or that much lower. That's where the two targets came in. And then the AI kicked in and said, but wait, we think you're going a little higher. And it went up to 337. It says, that's where we think we're going. We did get out back here. So I'm happy to pat myself on the back when we get one right. I'm also wrong, oftentimes, as all traders are. But you got to be fair. So if you're going to pat yourself on the back, you got to say, well, darn, we could have gotten more out of this if we'd have listened to the AI here. But we still had a nicely profitable trade, and there's never anything wrong with taking a gain. Don't second guess yourself or you'll give yourself an ulcer. Trading could do that easily. If you have a gain, you're happy with it. When you close it out, don't go back and second guess it. Learn from it, but don't go back and second guess it. But the AI was right. And then we've continued higher from here, which has been really surprising. So we got to the AI target and we stayed here for a couple of weeks. And now we've had two big up days. What are the metals markets saying about the dollar? Do they think that we are going to break lower? Are they looking at this Elliott Wave chart and saying, we made a new wave 5 low? Remember, the low was back here on the beginning of July. And we could come all the way down into this tap box, which stands for time and price projection. I was hoping that we'd get back in this Goldilocks channel that I've been calling it, which is really constructive for equities. Having the dollar a little bit lower helps exchange rates, et cetera, without the concern of would other countries dump their dollar holdings if they start to show big losses on those holdings. So, we're not quite that low yet, not to justify gold moving this much higher. So this makes me a little uneasy. Is there something we don't know out there? Is that going to be the trigger that creates a corrective move in the S&P, in the Qs, that something unforeseen happens? The market prices in things that it expects to happen, but a black swan event, something that we don't know of. Is that something that the metals market is pricing in? Because this is really shocking to me that we're moving that high. We put the moving averages on here. You can see we're quite a bit above the 10-day moving average. I thought yesterday, and I talked to our subscribers at Evo Trader yesterday, that I thought maybe after that breakout move, we might consolidate and do a little backing and filling. No, we didn't. We gapped up again today on gold, and silver is following suit. Not quite the move today as you had in gold, but also well above the 10-day moving average and ripe for some sideways backing and filling. So getting a little bit of follow through from that breakout move. We're getting a little vertical here now on the silver market. Before with gold, we were more vertical, but we had a nice uniform symmetrical Elliott Wave pattern going on here in SIL or SLV, excuse me. We had a trade on SIL, kind of going to give you a little bit of a hint of where we're going to go. You won't figure it out yet, but for the case study consideration. But now we're starting to get a little vertical. So maybe we're getting a little bit of that FOMO move in the metals. Either that or there is something that they're sniffing out that we haven't quite figured out yet in the markets. And that's keeping the VIX a little bit elevated. We're coming off that 15 low and we just pegged there. I've shown you this. I won't go back and waste the time to go back. Show you last summer, it was 12 and a half. This summer, it was 15. And with this descending triangle, remember that does not guarantee a downside breakout. Any triangle can break either direction. And something, do we get a black swan type of thing, something unexpected that spikes the VIX? It's always a possibility. So we have to be aware of that. A break to the downside out of this triangle, I feel like would be a little bit of a meltdown in the VIX that could coincide with a continued melt up on the S&P. I don't think we get a big breakout to the downside because there's just not that much room to go lower on the VIX. So I think that you'd have to lean towards the risk, even though, again, it's not smart to do that in a triangle to a potential upward move. I think we need to be aware of that and be cautious of that. In the meantime, back to the fact that it's a stock pickers market at this point in time. If we go to energy, UNG just won't give us that oversold bounce that I've been expecting. We've had this big downward move, and I've been thinking, and we do have a long trade on in the speculative portfolio, which every time it starts to look good, we retrace back down. My expectation here, and it's nothing more than that, is that after doing this for a long time, you learn on these big downward moves that at some point in time, the sellers become exhausted. Anyone that's wanted to sell has sold, and it doesn't take much to give you an oversold bounce. And that's all I was looking for. I'm not looking for any sort of a big, massive run in natural gas. We've been talking about the supply-demand curve. We know there's demand coming for natural gas, even greater than what we have. We have the winter coming, but we also have all those data centers that are going to be built. The administration is against solar and wind power, the electrical grid, rehashing this numerous times, cannot handle it. We don't have the capacity for it, so we got to go somewhere. Natural gas is likely where we're going. That's what the companies have told us they're going to use to build the data centers. But even that has not been enough to overcome the fact that we have a lot of natural gas. We're the Middle East of natural gas in the U.S. And until that flips, we're going to see this kind of stuff going on in natural gas. I thought maybe we had exhausted the sellers. There's still some in there. So the opposite of where the market is programmed to buy the dips in the equities market, we're programmed to sell the rips in natural gas. So every time it bounces up, they sell into it. So that's the other side of the buy the dips coin, kind of an expression that's been around trading forever, buy the dips, sell the rips, that kind of thing. So that's what's going on there. And then we go to oil. Zach, we've got to get that 10-second clip of the song remains the same from Led Zeppelin, because my goodness, it really has on USO, on oil, just pegged to 75. So now we increase the triangle once again. At some point, there is going to be a breakout of oil. The further this triangle goes, the closer we're getting to a breakout point. Every time it looks like maybe we're going to go, there's no follow through. Look at all this. And one of the rules I talk about, when you have a breakout type move, you have to have a follow through or confirmation day. We broke higher here, no follow through. Broke higher here, no follow through. Broke down here, no follow through. Broke down here, no follow through. So you get the point. And so when that's occurring, it just means you're building a larger triangle. So I'd like to take a look at the ADX, which is really low. Anytime the ADX gets down around 10 or lower, that's about as low as the ADX gets. And a low ADX means you're in a trendless market. And that means that likelihood is you're going to have some sort of a breakout. So perhaps we get a breakout in oil sooner rather than later. We'll have to wait and see, but we've been saying that for, gosh, nearly a month now. Luckily, we haven't had a strangle on here, or all that time going by would have been the painful watching the time decay erode. But maybe we're getting to a point where this can make some sense. It's one of the trades that I'm going to look. It's not the case study consideration for today, but it is one I'm going to look at as soon as we finish this broadcast here. So oil, not much else to say. Consolidating, it's going to break out at some point in time. Then we go to the crypto space, and with a little bit of a tick down in the dollar today, we're also getting at least a hold here on BITB. I know a lot of you like IBIT. I keep saying this over and over again, but both of them very liquid in options. The IBIT does have weeklies where the BITB doesn't. So if that's something that you're looking for, very short-term type stuff on one of these Bitcoin ETFs, then maybe you prefer IBIT. Other than that, there's really not much of a difference. I've traded them both. But here we are at the wave 3 here. And that's where we'd like to hold because we're kind of below the 50-day moving average. And if we break down, then we have to look for this B wave here of the zigzag. And if we are going to progress, which it looked like we were, and then the disappointment of the Fed meeting, the cryptos really wanted to see the Fed be a little more dovish. They weren't. And so they came back down. And why is that? My opinion, and I'm not a crypto expert. Zack knows more about crypto than I do. There's a lot of other crypto experts. And one of the correlations has been kind of crypto going against the dollar, because the longer term view of crypto is that one of them, I don't know if it's going to be Bitcoin, Ethereum, one of the other small. The question was asked yesterday, again, by one of our subscribers on what do I think of gold-backed cryptos, which I think makes a lot of sense. I'd be in favor of that, but they're smaller, and I don't know if they're considered altcoins, Zach, or if they're gaining a little more popularity than that. But something somewhere down the road is why crypto is really taken over as more of a novelty than something that's likely going to happen some point in the future, that we move away from the traditional US dollar into a digital currency. I think that's very likely. But I think it's just throwing darts right now to figure out which one we will be pegged to once we get there. And that could be years away. I'm not trying to say that's anything in the near future. That could be well down the road. But it has brought in a new breed of traders for sure into cryptos. And then Ethereum, taking a look at that, kind of holding here. We're kind of too far for this to be an extended triangle. But one possibility here with the fact, and before I take this arrow away, it looked like we were breaking out. We had the stair step, vertical move, vertical move, horizontal, and then we consolidated into a triangle here. And it looked like we're going to break higher, no follow through. Another breakout attempt, no follow through. Broke to the downside, at least so far, no follow through. I know cryptos trade 24/7, but there is a calendar rollover, as I like to talk about for end of day software programs. So you do get a print like this where it looks like it closes like the regular market. So what I'm drawing here is just a question of, is this not a symmetrical triangle? Is this more of a descending triangle being formed? Well, we'll find out if we can hold this 30 level here, which does coincide with the 50-day moving average. And if you're long Ethereum, at least for the shorter term, you want that area to hold. You want 30 to hold on the ETHW, one of the ETFs for Ethereum, the one I like to show because, once again, very liquid in the options. So we'll see if that can hold. Break down from there, and we're probably coming all the way back down to this step on the stair step pattern because of that vertical breakout move. So it's tedious here on Ethereum, but nothing to be too worried about yet unless we break that 30 level. Then that changes the game, and we're likely in for a bit more downside. So we'll see which way it breaks. But even though it's a descending triangle, remember, it doesn't mean a downside breakout. We could break higher out of the descending triangle. Zach, I'm not going to do the global stuff. I've talked a lot. I did want to leave some questions for Q&A, and I wanted to leave you a few minutes to show today's case study considerations. So I think I'll stop there, and we'll open it up to questions, and then maybe with 5 minutes to go, you can come in, because I do think everybody's going to be excited about today's case study consideration, or at least some of you are, based on the comments that you make. So
Sounds like a great plan to me. Let's kick off, and we'll start out with a question here from Trade Simple on Roku, ROKU.
ROKU. Good old Roku. Man, that was one that we talked about way back, right? And then the whole world of streaming and everything changed with smart TVs and stuff, but still a lot of people big fans of Roku, obviously from this pattern. Very nice 5-wave pattern moving up, having a good day today, at least up till now. We are approaching that tap box. We have a 63% extension, which is where you would expect to go, because roughly the wave 4 was a 38.2% wave 4 correction. That gives you expectations of 61.8% on the extension, and that's where we're there. So if you're long this stock, I see no reason to get out. If you're looking for an entry, I think you want to see a break of this wave 5 high with a little bit of follow through, and then perhaps we could go higher. We're also sitting at that big round number of 100, which oftentimes is a point where people sell. You can go back and look right here. We got up to 100. Few people took profits, but not a lot. And it found itself and bounced back up at the wave 3 high. So maybe the people that are interested in going long this stock are overwhelming those that wanted to take gains, or it was just a few people took profits and nobody was really interested in trying to short it and push it down. This is more of just a rebound move. It wasn't really a reverse short covering move like we've seen in Tesla. Anyway, again, if you're long, no reason to get out yet. You'd have to break that wave 3 low. And then if you want to get long, just be a little more patient and let it break that wave 5. All right, next one.
Thanks, Rob. Next up, let's go to SoFi for Lisa.
I want to look at this one too, Lisa. This has seemed to be forgotten for so long. You can see back here, I was really amazed that it just, there was no real interest in here, which was surprising to me. And then it caught a bid, as they say, and took off. And boy, did it take off. And you can see this big vertical move to the upside. We're in the wave 3 here. We did kind of go sideways for a bit here around this 25 level. And at that point, you didn't know if that was going to hold or not. We could have come back down and tested 22.5. We did once, actually twice, but not the third time. We took off, and that was one of my mentor's rules. Third time's the charm. When you test a point of support or resistance on the third go round, whatever happens then tends to be where you're going to go for the short to intermediate term. And so that's been a good example of it. So we tested it, moved down. So that's one test. Tested it again, moved down. That was the second one. We're back up here again for the third time, and we held and broke it. We didn't move down to the lower, and so we continued higher. So the question becomes, where do we go from here? Well, let's look at these. This was an impulsive move here. So let's see if we have a zigzag right here. 50% correction, but we're right at that 100% extension. So that's what's supposed to happen on the zigzag. And now, just like I was talking about with the S&P at the beginning, you wonder, do we get an extended C wave? Remember, the wave 3 is where you get most of the extended C waves. And all that is fancy terminology for the C wave extension goes to the next fib level. That's all that means, an extended C wave, which could get us up to 32 and a half. That would start to get pretty extended. We're a little bit above the 10-day moving average. If we look at the DMI, it looks kind of constructive. So perhaps we can go higher from here. But if we were to make it up to that 161.8% extension, I would be a lot more cautious at that point. But once again, just as I just talked about before, if you with Roku, if you're long, no reason to get out yet. If you're looking for an entry, I'd be patient here. If it closes here, which it may not, because we have a couple hours ago before close, that doji might mean a retracement here back towards that 10-day moving average, or maybe we just go sideways and let the 10-day moving average catch up here. If you wanted to go long, let that wave 3 high get taken out. If you're long, no reason to get out at this point.
Next up, we have Manuel, who is asking about a triangle breakout for NAK.
NAK. All right, let's take a look. So that would be not NAKA then, NAK, Northern Dynasty Minerals.
That's
Well,
correct.
it hasn't been trading very long, so I don't know if you can call that a breakout. I hate that vertical stuff. We're well off the highs of the day. I know a lot of people like to trade in these lower dollar stocks because you can buy a ton of it. There's a little bit of a greed factor involved there. So we open kind of ho-hum, and then people jumped in. But we're way above the 10-day moving average, although with where we're trading right now, not nearly as far as we were on the high of the day. I have no idea where this could go. There's just not enough data from a technical standpoint to give any sort of a conclusion or expectation. But I would just watch, and your line in the sand is going to be 90 cents. So that's the one thing that we do know. If you're in this space and you're wanting to see if you can catch a further continued move higher, which who knows, maybe you do, but your stop should be at 90 cents. That's where it opened. A break below that, and perhaps see what happens when you have these IPOs. Perhaps it IPO'd a little bit higher than people thought. Some people took gains immediately, but it wasn't one of those that nobody cares about this and the IPO comes out and you just get a slow bleed down. Sometimes that happens when it's not a very well subscribed to IPO or nobody really is interested in it. So there was a quick profit taking, then we turn and move back up. So if you wanted to try to catch a further run, stay long as it stays above 90 cents. But that's your stop. If it breaks that, I think you've added a lot of risk to the position, and perhaps you get out and then wait and see if it can hold 80, which is where it found support on the initial profit taking.
Thanks, Rob. This next one we haven't looked at in a little bit of time, so I'm interested to see it. It's going back to the quantum space for JJ, and that's QBTS.
Yeah, this was getting asked about a lot. And then when we kind of had the pause and the whole tech rally, this kind of took a bit of a pause as well. And it's getting some renewed interest. As you can see, there was the resistance there at 20. We've broken above that, but once again, a little bit vertical on the breakout there, a little bit above the 10-day moving average. So might watch for another opportunity like this. It's an extended wave 5, but I have a suspicion based on this pattern that 5 could relabel to a 3. Let's see what the DMI looks like. Still looks pretty solid. We're overbought at the moment, so I wouldn't be surprised for some backing and filling. That doesn't mean it's going to. It could still take off, but I think we keep an eye on. You're going to have to watch for any of these big tech stocks. The quantum stuff is going to have a lot to do with where the Fed goes. So I would keep an eye on that PCE report on Friday. If it comes in a lot hotter than expected, that's quote the Fed's favorite inflation indicator more than the CPI or PPI or some of the others. And if that comes in a lot hotter than expected, stocks like this or um, uh, any of the individual ETFs or stocks might get hurt a little bit. But if it comes in weaker than expected, then that could give the Fed green light for the second rate cut, and that could put a renewed bid here. So a little bit of caution right here, but if you're long this stock, once again, no reason to get out. And if you can handle some pain, there's always a possibility that comes back and tests 20. See, it was resistance back here in May. It was resistance again in July. We broke through it, but we have not come back and tested it yet. Oftentimes, when you break a resistance point, it tests it to confirm that what was resistance is now support. So that's the only thing that really makes me nervous here and watching the inflationary reports. Other than that, who knows how far it goes, but um, it seems to be happy with what the Fed said, at least. So far.
It does, yeah. Interesting one to keep on the the watch list, and I jumbled that up with the next symbol, Rocket Lab, RKLB.
Ah, you're getting a little bit ahead of yourself there, huh? So Rocket Labs, so RKLB, is that what you said?
Yes, sir.
Yep. Okay. Yeah, another one that we haven't looked at for a while. So you guys are, that's why I love doing this show. I say it each and every week, but it's my favorite show of the week. Um, the questions you ask are good. The stocks you look at are not necessarily the ones we hear about day in and day out. But this one's a fairly easier read than some of those others because resistance is right there at 55. So if you're long, again, no reason to get out. If you're looking to get in, let it break 55 first. Show some patience. It's a little bit overbought on today's high, but that's a pretty strong move. A little bit early to get a full volume count, but pretty good intraday volume there so far. So I think that lends to a better than average chance that we do break that resistance level. So yeah, I would keep a keen eye on this one for a break above that wave 5 high. And then we could head up near 70 on that. So watch that one also.
All right, heading over to Oracle. Um, excuse me, I'm sorry. Well, you can cover that one. We got some more questions. I realize that was the third symbol, but I think there's some other requests for Oracle here, so that works.
Yeah, Oracle. I think everybody knows the story here. Their quarterly report came in. Nothing to be excited about. It was very ho hum. They even slightly missed, but they gave way unexpected bullish guidance, and that caught a short covering rally, and boom to the upside. I mean, nobody expected that forecast that they gave, the guidance that they gave for the next quarter. That created the big spike up on their earnings. Too vertical, too fast, backing and filling. This is when you hear me say backing and filling, that's what this is. So you back off a little bit, you go sideways, fill a little bit of the gap, um, consolidating, all those things apply to that term backing and filling. This is a perfect example of it. And so, can Oracle go higher? That was a heck of a move. I don't know if it's still intact or not, but at least momentarily it moved Larry Ellison above Elon Musk as the richest man. But with what Tesla's done, I don't know where that stands yet. Not something I really follow. It just that was the headlines. But yeah, I would keep an eye and see if Oracle can hold 300. If it doesn't hold 300, then we're probably going to fill a little more of this gap. But with that guidance, it's difficult to get in front of it and short it, at least not now. Maybe with more information as we get closer to the next quarter's earnings report, if people doubt that they're going to hit the guidance that they gave, then maybe you could sell some selling or see some selling. But for now, I think at worst, Oracle continues this kind of stuff, and at best, it could even continue higher. That big 400 number is looming up there. We're not quite high enough to be in the tractor beam, but a break above that, wave three high at 350 likely means Oracle's going to 400, but that's getting ahead of ourselves. We're not there yet. So if you're long, stay long. If you're looking to get in, I think you could get in this one at any point in time. Just know that 300 should be your stop.
Very well. Next up, we have BE, which is Bloom Energy for Philip.
It is interesting that some of the energy stocks, and gosh, we had one that I took off yesterday on solar, which I don't understand. Um, yeah, they had some charging machines, but Elon seems to have the monopoly on those. So we had a nice bump up yesterday, and we took two of those off. And at least for now, looks like the timing was pretty spot on. But easy Monday morning quarterbacking on the following down day. What if we turn and head back up? But this is a good example. I'm glad you asked about this one. You always hear me talk about I like it when they move in a 45-degree angle, because when stocks move in a 45, we all know that stocks move in impulses and corrections, right? That's the crux of Elliott Wave. And when you have a 45-degree angle move rather than this more vertical stuff, the corrective moves are not as volatile. But then when you start to go more vertical, then you bring in some more potential volatility on the corrective moves, and that's what we're seeing today. So it got a little vertical, little too far, too fast, and so we're recovering that. So on this one, you'd watch first the 10-day moving average, which we're almost there, and then maybe even down to 70, I would say. If it holds 70, this could continue back higher. I don't know what Bloom Energy does. I don't know what space they're in. But for now, yeah, I would keep a close eye on the 10-day moving average, and then that level. You break 70, I think you got to get out. And that's 7 points away, so that would be uncomfortable to see it to hold it below that. But that's from a technical standpoint where you'd really be concerned. Up till that point, it's just trading.
All righty. And I see we're right at the 5-minute mark where you'd mentioned leaving time for the case study consideration. So we can transition over to that if you like.
All right, we'll do that. And I'm going to defer to the AI signals that I talked about earlier. And I get asked about this a lot. The metals have been moving, the miners have been moving, GDX for gold, SIL for silver. And so now we're going to add uranium in. So the uranium miners ETF, URNM, is going to be our case study consideration for today. We've got a 70% chance based on the AI to go up to 67. We are a little bit overbought right now, so if we back up a day or two, wouldn't be too concerned with that. And then when we look at the DMI, you can see it's pretty darn constructive there. Good separation between the two directional indicators. The ADX moving up nicely, not near 40 yet, so looks pretty solid there for a continued move higher. Not really a clear zigzag in that wave three, but we consolidated for quite a while here on uranium, at least on this ETF, right at 50, and we've broken from that. Started in a 45-degree angle, which we wouldn't have gotten a little bit of this vertical tinge to it, but perhaps we come back to that trend line a little bit. But the AI, when it finds these momentum runs, those of our subscribers that have the AI signals know that sometimes they continue vertically till they hit the target. Other times they back up a little bit and then run to the target. So sometimes these targets can be hit rather quickly, 1 to 3 days, and then other times it takes a little while for some of the backing and filling before the next impulsive move comes. But I like the space this is in. The whole sector seems to be moving. Maybe uranium ETF on the miners plays a little catch up, just like SIL did to GDX, etc. So that's going to be it. All right, Zach, you can take it away.
Alrighty, I will go ahead and take over the screen here and we'll head over to the platform. All right, we should have it now. So here we are, menu view, a jumping off point of the platform. And is this going to be an official idea this week, Rob?
Yeah, it is.
So we'll go up to this right toolbar on the top right-hand side, go over to ideas and the light bulb symbol again to create an official idea. Real quickly, I'll go back and show you the difference between an idea and a post. A post would be, in this setting, more of a discussion board as the criteria is not fully met for what Rob is looking for to make it an official idea, whereas an official idea like we're doing today can be equated to paper trading as if you were doing that with your brokerage. All of the data and contracts, quote prices, everything would be the same as if you were actually trading with real risk on the line, except there isn't any risk. So you can have a bit of a practice run at it, for lack of better terms. So this is going to be on stock symbol URNM, which is again the uranium ETF. We're going to go for a target price of 67. Is that correct?
Correct.
And the time frame we're looking at for that?
Let's do the 3 months.
3 months. We'll go down here to a quarter out and we will, as always, come back and make this look a lot prettier here right after the session is concluded. But as we can see, I'm going to publish this idea. So it's now available for you to come in and interact with, agree or disagree. Whether you agree or disagree, we welcome your opinion and just overall thoughts equally. As I've said, for those who've been around for many many moons with us, they're very familiar with this little dissertation. But for anyone that might be new, opposing opinions is what makes markets. If everyone agreed, everyone was in a buyer's market, there just wouldn't simply be a market. And same goes for sellers. So there's got to be an opinion on both sides. And so as we'll click into the idea from previous weeks. Well, that's actually just my idea from this week. Real quickly, just wanted to give you a view of what I'm referring to here and agreeing or disagreeing. So I'll just click DC Pilot's idea here. And as we can see up top, that's where you have the availability to agree, disagree with the idea. And then, of course, share your supporting evidence, just always keeping in mind to be courteous of the ever-growing community here. Rob has emphasized this in the past, and just to further that, it's great to see everyone's overall well thought out thoughts and context and just overall supporting evidence behind their ideas, and just to see the overall discussion. Without discussion in the world, and with especially the world in options trading, we wouldn't really get anywhere. That's how growth simply forms or comes about, is by discussion with others who are well informed. So again, I'll stop rambling and just wrap up my thoughts with please feel encouraged to come in and interact with this idea that's now available on the platform. And I will pass back over to you, Rob, to wrap things up.
Yeah, couldn't agree more, Zach. And I get notifications from the Hub group every time somebody joins the social media aspect there. I think it's a wonderful addition to the software program, not just a technical analysis program. The social media aspect is growing daily. So people signing on every day. And it's great to see respectful opposing ideas. It helps you as well. So if you have a viewpoint and you post something, somebody may come up with a thought that you hadn't thought of, and you're like, it's a good thought, and take that into account. Or maybe it's just a flat out disagreement. But yeah, as long as we keep the comments respectful, it's a value for everyone, and it's a great educational tool in addition to the interaction, which a lot of you do already greatly here on TradeFinder. So thanks as always for spending some of your trading day with us. And we did have a little bit of a tick down in the markets that occurred just before 1:30. We're trying to recover that a little bit. I'll have to go find out if some sort of a news event came out, but there was a spike down in the market, a spike up in the VIX. So we'll figure that out. Also allowed us to put this in with a little better entry here on the URNM, because it went down just a little bit as well. So maybe we're already fixing the slightly overbought condition there. So let's see how this one plays out. We closed down, by the way, URI today on the high of the day. Didn't quite make it to 1,000, but it was nicely profitable. I like to take things off when we get these gap ups. So it's turned out to be a nice idea. So this is the only TradeFinder idea from me at this point in time. All the other ones have been closed out. So we'll see how this one plays out in the coming weeks. So thanks again for your attention.